Thanks everybody for joining the Hustle Firm for the Stay Strong webinar series. We're going to get started here. So it looks like we got a good crowd today. And with that, I'm going to turn this over to, we got a special guest today, Brian DiGiaco, joining John, partner here at RDG, myself, partner here, as well as Brian. So excited to have Brian today. He replaced Chris. And I'll kick it over to John. Quick reminder though, first, questions. Please put your questions in the Q&A section. If you see another person that has a similar question, just like it, and then that will push it to the top. If you have issues, throw it in the chat. Shelby will help you, and we'll get the slides and the recording after.
Great, thanks, Dan. Thank you, everyone, for attending. And we'd also like to thank our sponsor for the T-shirts, Nike. I appreciate the new shirts. If you guys haven't seen them yet. Want to remind everyone, hope that everyone's staying safe, staying healthy during these times. You know, we're always thinking and praying about people. And like we've said, you know, these webinar series are just a way to help you with the economic impact here of what's happening. And obviously, the health impact comes first. And our thoughts and prayers are with everyone that has been impacted by this in some way, shape, or form. We also want to thank our research team. So we have Tim Hearn, Chris Gamble, partners with our firm, and Ryan Lynn McCullough is behind the scenes answering your questions. Our goal is to answer as many questions as we can while we're presenting here so we get all your questions answered. And like we've said in the past, sometimes there's more questions than answers. We also want to thank Crescendo Design for helping us put these PowerPoint presentations together. And of course, Shelby, who's behind the scenes here monitoring things. If you have any issues, throw them in the chat and Shelby will help you out. Here's our agenda for today. And today we're probably not going to use up all the time. We try to slate 30 to 45 minutes for these webinars. However, if you do have questions, we really want to crank on the questions because a lot of you have been funded already on the PPP and now you're in the forgiveness phase. We'd be happy to answer your questions. So we're going to cover the latest news, the pending guidance, the new Main Street lending program, and that's what Brian is here to talk about today, and then go over your questions and answers at the end.
Awesome. So with the latest news, obviously we're going to focus on Twitter again, so we're getting the most up to date. So the players, as a reminder, we've got Treasury, Steve Mnuchin, SBA, Ovita Carranza, Marco Rubio has kind of really been out front on Twitter, making sure everyone's up to date on what's going on. Trump signing things into law. We've got our senators, Mitch McConnell and Chuck Schumer, that are at the forefront of all this. Nancy Pelosi, Speaker of the House, and Kevin McCarthy, Minority Leader. So those are the players. The players that made a difference this week. We're actually going to do a little throwback to remind everybody that the first round of funding ran out on the 16th. We've been actually focused on the second round, which was introduced in the Senate on April 21st. The House then passed it by the 23rd, and by the 24th, it was signed into law by the White House. The SBA then quickly resumed accepting applications, so that was by the 27th, which takes us to the first day they had accepted about $50 billion. I'm sure we have an update there on the number of loans that have been issued. I think the last we checked, there was almost $200 billion of the second round was accounted for. And then this round, you know, the Treasury has really been highlighting the fact that 2.2 million loans have been made. So on May 3rd, Mnuchin tweeted 2.2 had been made, which is more than the number of all loans made in round one. So obviously the dollar value, the average dollar value is going down, and smaller businesses are getting those loans. So what they've really been harping on over the last couple of days and really the last week is people returning the funds. So back on the 27th, we found out that almost $2 billion of the first 349 had either been declined or returned, and therefore it goes back in the pot and made available to other small businesses. So they've, you know, then have really been hammering on, you know, that private schools with endowments. You saw Harvard, you saw the Lakers, you saw Shake Shack, Ruth's Chris, some of those bigger entities, public companies, larger companies that took these funds, and they're really trying to get those whether for publicity or the fact that they really didn't need it, trying to get them to return that. So they tweeted out, they're tweeting out examples of all these companies that are returning the fund. Just for some dollar values, we included this one. So the Ashford Hospitality Trust is repaying $68 million in a PPP loan. So, the question is, we thought there was a $10 million cap to begin with. How'd they get $68 million? So they're actually returning that. The original rule was that if you made the certification that you needed it, you really don't, you could return it by May 7th. They then came out and said on May 5th that the deadline is now May 14th. So they added a week to return the funds and get those back in the pot based on that certification. So we'll talk a little bit about that on the pending guidance type stuff when we get to that slide. But so that's really what the news has been about, is the certification, making the certification, and for all those companies that are returning the funds. So now with the pending guidance, we're just going to go through this quick. Unfortunately, what we had really hoped was there was going to be this treasure trove of guidance, but there really wasn't. So we're going to go over kind of what still is unknown and then certain things that have happened since the last webinar.
All right, so we're going to give you our position on these items that are here. And this is what we kind of call the frequently asked questions that we get in talking with our clients as it relates to the PPP. So the first is cash versus accrual. We're getting a lot of questions of how does the 8-week period work when it relates to my payroll? Is it based on when I actually pay the payroll, or is it based on actual payroll dates? And our recommendation is that you use an 8-week period, 8 weeks of payroll. So if your loan closed today would be day 1 of the 8 weeks, and you'd go 8 weeks forward from today, and that would be your 8 weeks of payroll. So that doesn't mean that you're paying for past payroll or you're paying for future payroll. You are paying for payroll incurred just for those 8 weeks. The same goes with rent and utilities and interest on debt and the other expenses that are allowable under the PPP. Number 2, limit on increases of compensation. There isn't a limit per the guidance that's out right now. Right now, there's only a limit on payroll compensation reductions. You need to pay at least 75% of what employees were earning last quarter. So we're using the reasonableness factor here in our guidance is if you are giving bonuses to anybody or raises, that they don't exceed any more than 25%. If someone's already at the $100,000, then we don't recommend you do anything more there, because that's one of the limits. And we also don't recommend that partners receive raises here. That could raise a red flag. Third one, expense catch-ups. I talked about that. Same thing. The intention here isn't to catch up expenses or prepayments, but if you are catching up expenses, make sure that you are still only covering overall 8 weeks of costs. Keeping people past June 30th. So as you know, you need to hit an FTE threshold. Your FTEs in the past need to equal or exceed the FTEs now after the 8 weeks need to equal or exceed the FTEs from the past. You have in June 30th to make that, you have until June 30th to make that happen. So a lot of people have asked us, if I bring people back on June 30th to ensure I get full forgiveness, can I let them go on July 1st? Our answer would be not a good idea. There's a 60-day window in which your forgiveness is reviewed by your bank. What we'd hate to happen is that you remove several people that you brought back by June 30th during that 60 days, and now your forgiveness is blown. So you got to be careful about that. How many hours is an FTE? We've seen all sorts of them. We've seen 30, 35, 40. We are going with the Affordable Care Act. The Affordable Care Act used 30 hours, which is the equivalent of 1 FTE. We recommend, though, when you're running your numbers, that you run them at both 30 and 35. It shouldn't make too much of a difference, but you should run them both ways. Rent. It's not just rent on your facility. Rent for vehicles and equipment. Personal property counts. So items like vehicles and equipment are considered personal property. So our position, our guidance is that rent relating to vehicles and equipment like copier leases would qualify for that 25, not to exceed 25% piece that you can spend on those items. And do new hires count under the FTE calculation? Yes, they do. They wouldn't count as a full one unless you've hired them from day one of your 8 weeks and they worked full time all the way through. However, they will at least count as a portion of your FTEs from the date that you hire them. So they're encouraging FTEs. Another thing I'd like to comment on is we're getting a lot of questions even today before the webinar about, am I okay taking the funds? Can I certify them? And Dan touched on that a little bit. My personal opinion is that these loans were meant for organizations, small businesses that are well under 500 employees, even under 100 employees. And you've seen that with how the loan size has shrunk from over 200,000 in round one to around 70,000 in round two. So we feel, and this is just an opinion, it's not a fact, but we feel that any audit, actually right away, anyone over $2 million is automatically subject to an audit. So if your loan is over $2 million, you're automatically subject to an audit. If you're under $2 million, you don't have an automatic audit. However, they do have a right to audit you. So you want to be very smart and follow a lot of this guidance. However, we don't know if you'll be audited if you're under $2 million.
Great, John. Thanks for that. And we'll get into, again, some of these highlights that we have. So the Treasury is really pushing out this guidance. They then push it to the SBA, and they're working together to administer these loans after it gets to the bank. So quick update there again, that the EIDL, so good note on the EIDL. Again, it was a $10,000 grant up to a maximum of $10,000. They later clarified that it was $1,000 per employee. Most of you that applied originally should have already gotten it. They did reopen the EIDL program. They refunded it for sure. So they added more funds into the program. And they reopened the portal. However, the portal is only open to qualified agricultural companies. So unfortunately, if you did not apply for the grant, you can no longer do that. You will notice the portal is open, but you have to be an agricultural company. Two is we are seeing more and more people get contacted if they were in either the paper application or the original online application where you submitted schedule liabilities, etc. We're seeing them get contacted and in some cases get funded for an EIDL loan. So not the grant, this is the actual loan itself, which could be up to $100,000, $200,000, $300,000. It's actually a maximum of $2 million. So again, we're starting to see some movement on the EIDL. Partners, so reminder that partners in a partnership can also apply and be included as a payroll cost up to $100,000. It's based on self-employment earnings. So reminder that even if you applied for and received your funding and didn't include yourselves in the loan amount, make sure that you would as part of your forgiven calculations. So you'd be limited to $15,384, which is 8 weeks of $100,000. Timing, most of you have gotten funded by now. If you have not, you have 10 days and you have to take it in one lump sum. So that was a clarity there. Really just can't delay it. It's got to get started as soon as you get approved. Certification. So again, this is what John was talking about. Our input and our advice is that we believe most of you can certify that you have been impacted and that there's uncertainty. That's the certification. They never ask you if you made money or are not making money. They never asked you to lay off a certain amount of people in order to get this. It was just, is there uncertainty? So a lot of stuff that they're focusing on is large companies that, like you saw in this week, got $68 million. And most of you fall into that small business category. SBA review, again, as John noted, loans over $2 million are automatically audited. Being audited doesn't mean you're automatically denied. So again, just a reminder there that an audit's not the end of the world. It just means make sure you have all your documentation right. Make sure that you answered all the questions appropriately, which is why you can use us as a resource, really, to make sure that you have everything, all your ducks in a row. Change in control. So again, this is just for those businesses that are either that you guys, obviously, if you're on the call, you probably certified, you're part of the buyer. If you had some estate planning that happened during this, as long as it's the same company, you're still eligible for PPP funds and forgiveness. So with that, I'm going to kick it over to our special guest today, Brian DiGiaco.
Thanks, Dan. I appreciate being a special guest today. I know I'm no Bruce Smith or even Chris Gamble for that matter, but I will do my best not to disappoint. So I'm here today to talk about the Main Street Lending Program. So at a high level, this is what I would consider the third round of any type of significant funding as part of the new legislation. I started out with the EIDLs, then you had the PPPs, and now you have the Main Street Lending Program. So it's really intended for anyone who either missed out on the initial PPP or the EIDL, or even received a PPP and find themselves in a situation with the current economic situation where they still need some sort of funding to get them through until the economy improves. So let's say, for instance, you received a PPP loan, you're able to keep most of your employees on throughout the 8-week period. It's now June 30th. Economy's starting to reopen, but you're still at a point where, depending on what industry you're in, we know that the economy is going to open up in waves. Also, depending on what industry you're in, you might start billing, but you might not be collecting money for a while, depending on your collection cycle. So this loan is really intended to help bridge that gap for companies that need to take it from that point in time to as the economy improves. The main key here is this is based on 2019 EBITDA. So this is meant for companies that did well previously prior to the pandemic, but now need a little extra funding to take them through. It's also based on companies. The other part of the calculation is current debt. So it's really companies that are going to succeed with this loan are companies that did well in 2019 and also weren't very leveraged at that point in time. The design of this particular program is it is going to be administered through banks initially, and then the Federal Reserve created what's known as a special purpose vehicle that is going to fund these loans and purchase back between 85% and 95% of the loans from the banks. So they're reducing the risk to the bank, which will result in the more likelihood of you being approved at the bank level. So just a little history on this program itself. So it was actually, way back on March 27th, it was actually signed into law in the CARES Act. It just made reference to the program at that point in time and said that the Federal Reserve would, at its discretion, roll out this program. On April 9th, some information came out. The Federal Reserve actually established $600 billion for the program. At that time, it consisted of 2 credit facilities, so 2 loan options, and they opened it up for public comment through April 16th. So during that time, companies could comment on the program itself, provide recommendations. They received over 2,200 letters during that time frame. On April 30th is when they released most of the information to what we know to date. Part of the changes on April 30th was they added a 3rd loan program. Now there's 3 programs under this loan, 3 loans, excuse me, under this program. They lowered the minimum loan size to make more small businesses eligible. And they basically said that there's going to be a rollout in early May, official rollout. So any day now we'd expect that banks would be getting guidance of how to administer this program. So as I mentioned, there's 3 options. All 3 options have similar standards and common eligibility terms and restrictions. And then each individual loan has its own criteria, mainly in terms of repayment terms, minimum and maximum loan sizes, and the lender risk. So eligibility. So first of all, you got to be a for-profit business. The board has stated that they recognize that nonprofits play a critical role in the economy, and they are evaluating a separate approach for them. To date, we haven't heard anything on that, but they are considering it and they are evaluating it. The business must be established prior to 3/13/2020. And then you can either have 15 or 100 or less employees or 2019 annual revenues less than $5 billion. So much more broader than the PPP program. Your business must be established in the United States with significant operations and a majority of employees based in the United States. So the act itself says no more than a 49% foreign interest. And then you can't already be participating in one of the other two MSLP loans. So like I said, there's 3 loans under this program. Once you apply for and receive one of the loans, you are not eligible for one of the other 2 loans. So we talked about the terms and conditions for all 3 loans. So these ones apply to all 3 different options, and then there's specific ones according to each option as well. So there's a 4-year maturity. The interest rate is based on the 1 or 3-month LIBOR rate plus 300 basis points. So it is an adjustable rate that will change. It's currently at 3.5%. Maximum, here's the key here. So we talked about how it's really meant for companies that were doing well prior to the pandemic. So they're basing your maximum loan size on 2019 EBITDA and a portion of your outstanding and available debt. So your 2019 EBITDA is calculated as your earnings, your net income basically, before interest, taxes, depreciation, and amortization. So you start out with your net income, you add back those 4 factors, and that calculates your maximum loan size. We'll get a little bit more into that with the specific example. For all 3 options, the first year principal and interest payments are deferred. So payments won't start until the 2nd year under this program. Repayments are permitted without penalty. So you can prepay this at any time. This loan cannot be contractually subordinate to any of your other debt in terms of priority. There's also some restrictive covenants in place. So you must refrain from using the money to repay principal and interest on other debts. So other than your scheduled monthly payments, you can't use these monies to refinance other debts. There's one particular exception, and we'll talk about it a little bit later on. You can't seek to cancel or reduce existing lines of credit that you have. And then the most significant piece, it'll probably play into effect for a lot of people, is restrictions on officer or employee compensation, capital distributions, and stock repurchases. So the restriction on officer employee compensation is basically if you have any employees that made more than $425,000 in calendar year 2019, they cannot be paid in excess of their 2019 payroll. So they can be paid more than
60 days to review PPPL forgiveness, right? Yes.
If they made more than $600,000, for instance, they would be limited to $600,000. Anyone under $425,000 that's not clear on, our assumption is you can be paid anywhere up to $425,000. There's no capital distributions allowed except for tax draws. So you can, for flow-through entities like S Corps, LLCs, you can take a draw out to pay your taxes. And then there's no stock repurchase. So basically what they're looking to do here is keep money inside the company. They're not looking for businesses to get these loans and then make distributions or buy back stock or increase employees' compensation. The key to these restrictions is they are in place for the term of the loan, throughout the term of the loan, plus 1 year after the loan is repaid. And then you're also going to make certifications as part of this program. So the certifications are obviously different than ones we did under the PPP program, a little bit less restrictive, I believe. You have to basically say you have a reasonable basis to believe you have the ability to meet your financing obligations for the next 90 days. You can't be expecting to file bankruptcy. And then this last one is where it's really lenient. You must make commercially reasonable efforts to maintain payroll and retain employees. So the first loan of the 3 options is the Main Street New Loan Facility. So as we talked about, there's certain criteria for each one. Each one has a maximum and minimum loan size. This particular one has a $500,000 minimum loan size and a maximum loan size of either $25 million, or when you take your existing debt, any undrawn available debt, so any untapped lines of credit, the combination of those two plus the debt you're going to receive with the loan cannot exceed 4 times your adjusted 2019 EBITDA. So we talked about what EBITDA means, your earnings before interest, taxes, depreciation, amortization. They do use the word adjusted. They have not provided any guidance on what that means. possibilities. Might be able to add back owner compensation. We'll see what that might be. On the repayment terms for this particular loan, the first year obviously is deferred, like we talked about for all the loans. Years 2 through 4, 33% of the principal is going to be due each of those years. The way the Act currently says, it's due at the end of those years. So typically you would pay monthly payments. It looks like this loan can be made annually at the end of each year at a third each year. The particular risk to the lender on this facility is 5%. So we talked about that special purpose vehicle that was funded by the Department of the Treasury. They are going to purchase back these loans anywhere between 85 and 95% to take the risk away from the lender. So an example here of the new loan facility. So we look on the left-hand side, we have the facts and circumstances for this business. Current debt is $200,000. Available but undrawn debt. So like I said before, amount you have available on a line of credit potentially, $100,000. And their 2019 adjusted EBITDA was $300,000. So you start the calculation, you take 4 times their adjusted EBITDA. That gives you 1.2 million, the 300,000 times 4. Subtract out the current debt, $200,000 in this case, and then available but undrawn debt of 100,000. That's a maximum loan size of $900,000. So that exceeds the minimum, so they would qualify for the $900,000 loan under this program. So one thing to note, there is the minimum of $500,000, and this is based on EBITDA. So if you had no other debt, you would at least need $125,000 of 2019 EBITDA to qualify for the minimum loan size. If you don't meet the minimum loan size, then you don't qualify for the loan. Another thing to consider in this particular instance, so these guys have $300,000 of potential debt outstanding. They're looking for a minimum loan size of $500,000. That gets them to $800,000. They would need, in their case, at least $200,000 of 2019 EBITDA to qualify for the loan because they had existing debt already. The second facility is the priority loan facility. So we'll highlight some of the differences here. The first difference is this particular loan is based on 6 times adjusted EBITDA. So you can qualify for a larger loan amount. With that, you see in the bottom left-hand corner, there's a 15% lender risk retention. So the SPP is only purchasing 85% of these loans, so more risk to the borrower, to the lender. The payment terms are also different. In years 2 to 3, only 15% is due each year. So this is a more backloaded. And in year 4, there's a balloon payment due at the end of the year of 70% of the loan balance. One other key difference with this priority loan. So we talked about earlier, you cannot use the proceeds to pay down debt other than scheduled debt. You can't, pay off a loan essentially. With this facility, at the time of origination, if you have debt with another lender, so different bank than the bank you're applying to this loan with, you can refinance that debt into this loan at the time of origination. If you don't choose that option at the time of origination, then the same rules apply. You cannot pay down or pay off any other debt with the proceeds from this loan. So example for this one on the next page, you have your facts and circumstances. Current debt for this company is $200,000. The available but undrawn debt is $200,000 as well. And their 2019 adjusted EBITDA was $150,000. Under this calculation, 6 times adjusted EBITDA would be $900,000. You subtract out their current debt and their available but undrawn debt is another $400,000. They would qualify for a maximum loan of $500,000, which is at the minimum. The third facility is the Main Street Expanded Loan Facility. So most businesses will probably qualify for the first 2. This one is really meant for larger businesses. You'll see there's larger minimums and maximums. The minimum loan for this one is $10 million, and the maximum is the lesser of $200 million, or 6 times adjusted EBITDA. And they also added in another limitation for this one. The limitation is 35% of existing outstanding and undrawn debt. So once again, this is the lesser of. So whatever one of these is the minimum, that is what you'd be eligible for. And it has to be at least $10 million to have any eligibility at all. Once again, the payment terms vary. So this is years 2 through 3. 15% is due each year, and then at the end of year 4, there'd be a 70% balloon payment due as well. And there's a 5% lender risk retention. So another example here, this particular company, $25 million of current debt, available but undrawn debt of $5 million, and their 2019 adjusted EBITDA of $10 million. So they would qualify for, if you take the EBITDA calculation, 6 times adjusted EBITDA would be $60 million. Their current debt would be $25 million. Available but undrawn debt of $5 million. That leaves you a maximum loan size of $30 million. And you got to take into account your other restriction, the 35% of available and outstanding debt. So in that case, they have $30 million. And if you apply the restriction of 35%, they'd be eligible for $10.5 million. So they would qualify for the $10.5 million, obviously being lower than $30 million, but also above the minimum of the $10 million. So some other things, important items to note here is, number one, if you receive the PPP loan, does not exclude your business from being eligible for this loan. Number two, the MFL LPs are not eligible for forgiveness. So different than the PPP loans, this is an actual loan. It stays a loan. There's interest rate, repayment term. This program is set to expire on September 30th. So the Department of Treasury made the initial $75 billion investment, and up and through September 30th, they will continue to fund additionally as needed up to $600 billion. There is collateral for these loans potentially at the discretion of the lender. So these loans may be secured or unsecured. There's going to be a normal underwriting process, and they'll make that determination. There are fees associated with these loans. So different from the PPP loan, there was no fees that were being passed down to the borrower. In this case, there is going to be transaction, origination, and servicing fees of up to 200 basis points of the principal loan amount. And it's up to. It's at the discretion of the banks of what they can charge you there. So, for instance, if you receive a $500,000 minimum loan, you could be looking at fees of up to $10,000 for these loan amounts. Lastly, I would say there's going to be more information forthcoming, particularly on the application process itself. They'll roll that down to the banks, and then it'll roll out to us. We're expecting a lot more guidance with these. As always, we're here to help. We can help you determine your eligibility. In the meantime, it's all based on 2019 numbers. We can help you determine your maximum loan size, and if it even makes sense for you based on your particular situation. Thanks, Dan.
Thanks, Brian. Super helpful. So again, just these stimulus programs keep rolling out. This is one of those relatively new ones that hasn't received a lot of news attention. More or less larger loans, but nonetheless an important program, and we're going to be at the forefront of this one too. So we'll keep rolling out information as it's available, and obviously a special thanks to Brian for being on that one. So now we're going to get into questions and answers. So obviously we've answered a lot of questions so far. And before we do that, one thing I want to note for a special surprise here for all of you that are on today, next week we're actually going to have Bob Duffy. So if you remember, Bob is currently president and CEO of the Greater Rochester Chamber of Commerce. He's also in charge of reopening the Finger Lakes region. So obviously a very important person right now. So next week we're going to have him on. So if you want to start sending questions to covid19@rdgandpartners.com, we'll send out an announcement for anybody that's not on today, but start sending your questions in for him as we look to reopen the economy. So we've answered some questions so far. I want to highlight a couple. One is that came in from Dave Wegman here. We got, can we bonus employees with PPP funds? So that was answered by Chris, and obviously there's not specific guidance that prohibits you from paying these bonuses. So we continue to recommend your normal payrolls and just make good business decisions. That's obviously the first point there. Don't be bonusing money as if it's free money falling from the sky, because we don't know if there's any restrictions yet on it. So make a good business decision first. John, you want to answer one?
Yeah, there's a question here on retirement expenses that we got ahead of time. Understand that these are eligible payroll costs, retirement expenses for businesses that do an annual 401k match. I was told that the annual match could be pre-funded during the 8-week period as an eligible use of funds. I would call that aggressive. There isn't exact guidance. Our understanding is that, yes, the match could be pre-funded just using 8 weeks of the match, of the annual match, versus using the entire match for the year. So going back to the guidance that we gave before, only use 8 weeks. So if your match is $100,000 for the year, only take 8 weeks of that. And I would use that same methodology for all expenses. I also want to thank Brian for all the detail on this Main Street Lending Program. This is brand new, and he studied it inside and out and knows it as well as anybody could know it so far based on what's out there. It is complicated, it is more involved, but I've never seen so much stimulus in my career that exists right now for small business owners. It's all over the place, the amount of stimulus, and we're learning about it every day more and more. The other 2 times I can remember where there even was stimulus was after 9/11, after the 2008 mortgage crisis, and this by far and away towers over the level of stimulus. So you want to make sure that your stimulus plan is put together in all areas, and timing is so key in capturing it all.
That's good. And then, so we'll take one more question here. Again, we've answered a number of these, but one was rent relief. So you got rent relief until August of 2020. How do I then, coordinate that and juggle that with the PPP? It's a great question. What we've been telling people is if you can negotiate again with your landlord and say, hey, look, I have PPP funds that'll allow me to pay you. I'd love to pay you. I want to add another month on to the end of that to really help my business continue and thrive. That might be one strategy for you. So something to consider. Obviously, if it works for the landlords, we have a lot of real estate clients that they also still have mortgage obligations. So just something to keep in mind there. So with that, I think the last question we have here is how do we get T-shirts? And so we'll have to figure that out with you guys and make those available. But the Hustle Firm, we really appreciate everybody that joins us every single week. We always end with the message, stay strong, and we hope that you'll continue to join us. We're going to try to keep these as relevant as possible as we navigate forgiveness, as we navigate these new loan programs. So please stay tuned every Thursday at 1:30 to the Stay Strong webinar series presented by the Hustle Firm, and we'll continue to provide relevant updates. Thanks everybody for joining.
Happy Mother's Day.
Happy Mother's Day, don't forget.